Francesco, great presentation. I have about 5 or 6 questions myself that I want to ask, but let me get through our one first. Obviously, the European Commission has done an amazing job of putting together the Pan-European personal pension product, which I personally believe sets the new gold standard for pensions, not just in Europe, but across the world. And I think this is a brilliant initiative to be able to bring that level of governance and transparency and, in fact, innovation in pensions to occupational pensions as well as personal pensions. So I think it's a brilliant initiative. And what I'm going to do today is essentially present one of the innovations that PEPP allows, which we are confident that we can easily slot into a Pan-European Occupational Pension so that everybody else can benefit. I can just put the screen up. I trust you can see that okay?
Yes, this is very well visible, Dean.
Okay, great. So obviously, our firm is Tontine Trust, but we're here today to talk about PEOPs. One of the things that PEPP has introduced is that it's opened the door to a next generation of pension funds for innovation. Innovation is not really a word that's associated with the pension sector. In fact, it's usually looked upon with a high degree of mistrust. But the reality is that innovation happens, and PEPP has enabled it in a very, very positive way. But in order for me to explain exactly what PEPPs have now enabled, first I'd like to explain the problem that needed to be solved by the pensions industry. And essentially that problem is that fundamentally everybody, all employees across Europe, share the same goal. They want to work hard, save money, support their families, and hopefully save enough so that when they get to retirement, they're going to be able to, have a wonderful, relaxing time and, enjoy their golden years. And this is what the pension system is designed to do. Unfortunately, as I found out in 2017, that dream is largely over for most people. The way I found out about this was a very personal way. It happened to be that my mother and her friends revealed that they spend an inordinate amount of time worrying about running out of money in old age if they happen to live a long time. So like any good and former investment banker's son, I went out looking to see if there's a solution for the problem. And I started to understand that this is actually a huge problem everywhere in the world. In fact, for savers aged over 55, running out of money in old age is actually now the #1 fear. And that's, this is a situation nobody could have anticipated when DC pensions were launched. Why are they so fearful? Well, currently what people do if they have a DC pension account is that when they reach retirement, they follow something called the 4% rule. And the 4% rule essentially is there to guide you towards making your savings last until you're about 90 years old. The problem with the 4% rule is that if you're a 65-year-old man retiring today, you have a 33% chance of living beyond 90, in which case you have a 33% chance of running out of money. Even worse, if you're a 65-year-old lady, you have a 44% chance of living into your 90s. So clearly the 4% rule is no longer going to work. So multiple private pension providers around the world have carried out studies to try and understand what savers actually want from a pension product if the 4% rule is now obsolete. And what they've invariably found is that 84% of savers, they want an income that lasts a lifetime. They want that income to increase over time so that it rises faster than inflation so that their standards of living doesn't fall. And they want great value for money, which means low fees and a high income for their pension savings. Unfortunately, this study, the main study that was carried out in 2017, the 100 insurers involved agreed that if a product has a defined benefit or a fixed rate of income, it's absolutely impossible to make all the numbers work and deliver all the features that consumers want. However, there's been a huge movement around the world for the last few years, initially started in academia, which has now been championed by policymakers, where they're talking about creating risk-sharing pensions because they enable higher income in retirement, and by spreading the risk as a collective among savers, it means that you can manage the risk in retirement without the need or expense of a guarantee. So initially, the UK was first to jump on this bandwagon in 2018. More recently, the OECD has come out and talked about the future of pensions, and they have devoted a whole chapter to explaining the advantages of tontines, in that they can offer everybody a higher income in retirement, and they can significantly reduce your risk in retirement by ensuring you don't run out of money. And all of this is possible without the need for a guarantee from an employer or from an insurance company or from a government. But most people in the world, unless you're 200 years old, don't even want to know what a tontine is. So let me give you a quick explanation. Essentially, what we're saying is that we'll get cohorts of a same gender, similar age, for example, such as 60 to 65-year-old ladies. They'll all accumulate their pension funds into a single closed pool. That money is then invested in a highly diversified portfolio. It's not just invested in bonds, it can get exposed to long-term investments, some equities, green bonds. It can have a much more diversified, almost like an endowment fund portfolio, as opposed to the old defined benefit pension systems. Then what happens is that when all these ladies reach the age of 65, they're all going to start receiving a monthly income, which is pro-rated to their contribution to the original pot. By 20 years later, you've now got less ladies in the pool, but the money is still there, which means that those surviving ladies are now receiving higher incomes in retirement. And then for those ladies that end up living up to 95 or 100 years old, instead of running out of money and ending up on the street, the fund is now liquidating the capital as quickly as possible to return it to the remaining members before they pass away. As a result of all this, means that the income increases over time. It's never going to run out of money. And actually, if you're one of the ladies that lives to be into old age, instead of having something to worry about, you're now having the best healthcare money can buy. Well, when you try and explain a concept like this to people for the first time, they get very confused and they say, well, this sounds a little bit unusual. Would people actually be interested in something like this? Well, historically, tontines were created in, I think, 1653. They were initially launched by the Dutch, of all people. And it was the first Pan-European pension fund because it spread across the whole continent. And it led Adam Smith to write in The Wealth of Nations that if a government ever wants to, issue a pension product, more money can always be raised by tontines by anything else. But it wasn't the only occasion. A little bit later, the USA read about tontines, about the European tontines, and they imported them and started offering them, and it absolutely transformed the US insurance industry, growing it by 600% within a single generation. So these are blockbuster products that appeal to people. But I guess the big question that everybody has is, what is the nature of this appeal? Why do they always have such a spectacular impact in any market in which they're launched? So if we think about normal pension products, they're not things that people generally get overly excited about. Those that do save in the pensions are probably because they've been opted in as a result of legislation, so they have to contribute, or they're looking to reduce tax, and some of them are even actually planning on saving for retirement, but it's very much driven by law and tax at the moment. If you look at another type of financial product that's in the market, which is a lottery, lotteries have no problem getting people to make voluntary contributions, and nobody is out there complaining that people don't spend enough on lotteries every month. But the reason people put so much money, unfortunately, into lotteries is that they're driven by this behavioral science effect, which is that they overestimate their chances of receiving an outsized reward for their contribution. The thing is, this behavioral science effect is not all negative if we use it correctly, because essentially that's what's happening in a tontine. You've got your regular pension product, which has, which is mandated by law, and it has the various tax advantages, but it also means that you now have this high degree of certainty that if you live into old age, instead of running out of money, actually you're going to benefit to a large degree, and you're going to have an amazing lifestyle in retirement. And this is what has always driven people to save as much as possible into their tontine pensions. So it's interesting for us to try and quantify what is the difference between a tontine PEOP versus, for example, an annuity or following the 4% rule. And the difference is actually quite harsh when you display it graphically. Essentially, the orange line represents the current value of an annuity in Ireland for €1 million. That's what you can expect to receive. If you leave your money in the bank and just draw it down, which many retirees do now, then you can expect to get about $3,000 a month for the rest of your life. But of course, that's going to run out when you reach your 90s. Now, on the other hand, if you pool your money into a tontine, the payments not only start higher than an annuity, and whilst they are variable over time, they tend to vary in a very positive direction as the number of members in the pool passes away. So if we talk about rolling out Tontine PEOPs, why would employers want to offer this? Well, essentially what they're saying is to their staff is that we're offering you a lifetime income until age 120. And for the employer, it adds no more costs and certainly no more liability than if they were just offering a DC pension. For the employees, they can expect that income in retirement is going to rise faster than inflation. The fact that the Tontine PEOP can invest in a broader spread of assets than just government bonds yielding 0%, and the fact that there's no guarantee required means that there's higher incomes in retirement as a result of better growth in the portfolio. And of course, the beauty of PEOP is that, as designed, it's going to adhere to the PEPP standards, which means that more or less, that all that governance and transparency that's been mandated by PEPP will now be made available for every worker of any country that's operating across Europe. And I think this is an amazing innovation. So in summary, we feel PEPP has set a new gold standard for personal pensions. Tontines offer the missing lifetime income pension benefit, which is what savers actually want. And on that basis, Tontine PEOPs can bring best-in-class protections, benefits, and portability to occupational pensions. And I, for one, will be voting to see this happen. So happy to take any questions.
Thank you very much, Dean, for introducing your Tontine ideas and sharing this with us. We have a question from the audience. For the Tontine, what about surviving spouses who would expect to receive a survivor benefit?
So the best way to explain this is that I was speaking to a very senior gentleman in Deutsche Bank recently, and he was saying that he expects to retire with a reasonably significant amount of capital. But the way he sees it is that he's going to take 25% of his retirement amount, put it into his tontine, 25% into his wife's tontine, and the remaining 50% he's going to split between his kids now so that they can spend that money to start a business or buy a house. So the reality is that the spouse, we would expect, and certainly will encourage people that the person that has accumulated pension income, if it's one working spouse, that they will divide that into an appropriate amount so that each of the spouses has their own individual tontine pension for life.
Thank you very much. I have another very nice question from the audience for you. Why did tontines disappear?
That is my favorite question, I think. Essentially, in Europe, the governments got so addicted to issuing tontines that it was burdening the states with a product that was too good for consumers. And eventually, over time, they realized that actually, if they just offered bonds, this is because tontines were invented and launched before the days of central banks, that if they just launched bonds instead, that they could get away with offering consumers much lower yields. And obviously, if the governments can save money, they did. In the US, after they were launched over there, the insurance companies launched the products. And there was such an overnight success that everybody went for broke to try and get as big as possible, as fast as possible, paying the highest commissions. And to pay these highest commissions, they started charging obscene levels of fees. And there was a huge investigation 40 years into the tontine pension industry. And they found out that the insurance companies back then, in the pre-regulation days, had been mismanaging the assets, tampering with the membership ledgers of the tontines to favor family members, and generally just behaving very badly. And there was a whole set of rules brought in the US, which prevented insurance companies from exploiting tontine members with fees that they didn't really need to be paying in the first place. And effectively, it destroyed the profitability of the tontine pension industry for the insurance companies. And as a result, they tended to switch back to selling annuities, which are a far more profitable product, not nearly as consumer friendly as a pure tontine, if managed correctly though.
All right, I see we have still 10 minutes, I think. Another question that came up is like, is there some kind of critical group size to run such a tontine?
Well, if we think about a situation that everybody else is already familiar with, if you reach retirement and you have 100% of your portfolio invested in a single asset, a single stock, that's a pretty risky bet that you're taking for your retirement. Even by just splitting that portfolio into two different assets, you've already now reduced your risk. And hopefully, if you're receiving the right advice, actually you're going to split that into hundreds, if not thousands of assets to protect yourself. The same sort of logic applies in the tontine. As soon as you pool your risk with one other person, you've reduced your risk. The more people you pool with, the more you're reducing that risk. But what we found is that the numbers for each cohort start working beautifully above 300, above 1,000. They don't get terribly better. But actually what we do is we tend to cap the pools at a size of 10,000. And that is purely for a gamification effect. We want Francesco to get himself down the gym every morning and train as hard as possible and eat the right foods, because we want him to believe that he's going to be the one that lives to 105, 110, to get the best benefit out of the tontine. So, anything that we can do that maximizes better behavior of the tontine members, such as eating better, exercising more, or saving more, it's the behavioral science all contributes and drives that.
All right, thank you very much. At the end of your answer, there came really quite some questions in. Maybe a nice question that for Francesco also in this respect. Who would regulate how the Tontine pool is invested, Francesco? Would it have any place in your PEOP proposal?
Well, about the investments, basically we are really following, we did follow in our reflection paper the approach that was already taken in part from the IOP directive and in part from the PEPP regulation. So basically, for example, when you think about investment options, we mentioned to have a limited number of investment options, say 6, just to a little bit get inspiration from the PEPP regulation. 2 of those investment options would be either guaranteed on the capital, or anyway there would be a protection of the capital through risk mitigation techniques. The others, of course, would be more offered and up to the PEPP provider to be chosen by the potential users. And then I would say the main rules about investments would be the general ones about the prudential prudent person rules and so on. Then, like I said, anyway, it depends also on the sectoral legislation, because we know that an asset manager and an insurance company and the NIORP they could set up PEOPs, but they would be still regulated by their respective sectoral legislation. So that's exactly the same approach that has been taken for the PEPs, and we will not see a reason to create new rules on the top of that.
Another question which you answered in written form, but which I think is plenary also interesting with respect to the PEOP, is like in what way does a PEOP differ from a contract-based PEPP, so an employer-organized PEPP?
But I think I would say that the difference is the same as we can have between an IOP and a personal pension product. If we assume that an IOP is different, so basically an occupational pension is different from a personal pension product, we know that according, first of all, to the national legislations and the approach in the IOPs, the employer and the employee, they both contribute into this pension vehicle. We know that usually or very often the taxation, the treatment of the taxation between second pillar pensions and third pillar pension is different. And I would imagine, and I would even guess and hope that the PEOP would be considered and fiscally also as a second pillar pension, and so it would have a different fiscal treatment, I would say better than a third one. And also in terms of governance, we know that in some countries, I would say in France, in Italy, in Belgium, also of course very much in the Netherlands, in the Scandinavian countries, the governance and governing bodies sometimes provide for bilateral participation from workers and employers representatives, and that would be possible in a flexible structure like the PEOP, it would be possible that the governing bodies would accept the participation also of workers' representatives. It would not happen with a personal pension product. So I will see that there is, the PEOP should not destroy, let's say, the nature and the cultural background of the European occupational pensions. It should be an added value, but should not completely destroy the tradition and the way how those occupational pensions work in Europe. And I think on these features, we would be absolutely in line, because the PEOP vehicle would be able to offer all these kind of solutions.
Well, thank you very much, Francesco, for highlighting these differences. I think we are slowly turning to the 1 hour session. I would like to finish this session by having a very thoughtful question for Dean. Are Tontines not exacerbating the growing generation wealth gap and therefore socially questionable?
Well, actually, there's a couple of aspects to that. In Ireland, we'd call that a hospital pass question at the end, by the way, Sebastian. But actually, it's another great question. There's two aspects. Right now, there's a perception that, you know, my parents are going to live into old age. They're going to reduce their spending over time. There probably won't be any inflation. So, you know, they're not going to need to spend that much. And they're going to leave me 50, 60, 80% of their pension. But the reality, if you do the math, is that there's a high possibility that these parents are going to live another 30 years in retirement. Inflation does happen. So there's going to be cost increases. So the perception that there's a benefit, there's a huge pot of money that's waiting around when your parents pass away, is completely false. The reality is what you're going to be left with is a liability. And in Europe, it's not, you know, it's a social problem that you've got to take care of your parents, of course. In the US, it's a legal problem because people that, if your parents are in a retirement home and they run out of money, the retirement home can keep them there and sue you to pay the fees of the retirement home. Yeah, that's not pleasant. The reality is that if you take care of your parents and they live a long time, you are going to be taking care of them when they run out of money. The Tontine prevents that. It's a solution that provides for a risk-sharing mechanism that makes sure it doesn't happen. But if I can, there's one other aspect to that question. If you look at many pension systems that are out there, they're using the monies, and certainly in the US, the state pension schemes, the state occupational pension schemes, are using the money of workers today to support the pension payments of those that have retired already. That is ridiculous because it is completely unsustainable, and that is intergenerational theft. Because that money is just not going to be there to pay those younger workers when they retire. That is the case in 49 out of 50 states in the US. The one remaining state, the one state with a fully funded pension scheme, is Wisconsin, and their state employee pension fund is the only one that's 100% fully funded. And why? Because they operate it like a tontine. So I think the questioner is right to bring up the subject of intergenerational theft or transfer, but actually tontines are the solution. They are the answer to prevent this, and it needs to be implemented as quickly as possible for the exact reasons that the person stated.
Well, thank you very much. I think that we slowly have to bring the conference to an end. Thank you very much for the audience for attending today. I hope that we could answer most of your questions. There's one last question, whether you could receive the presentations, at least of one of the speakers. I received confirmation that I'm allowed to send out the presentation in PDF form. If I receive after the conference another confirmation, then I'm happy to circulate these. You would, for that, would need to circulate an email to my professional email address that can be found widely on the internet, I think. Then I'm happy to circulate that to you if I receive the permission. I think we also try to record the conference today. If that managed out well, it might also be possible that we are able to bring it on the internet so that you can rewatch it or share it with anyone with whom you would like to share it. All right. Thank you very much, and have a good day all. Bye-bye.
Thank you. Thank you very much.
Good
Bye-bye.
guy. Fantastic.